Today, markets are in turmoil again. Hello again, it's Martin North from Digital Finance Analytics, who I've noticed posts covering finance and prop news with a distinctively Australian flavour. Well, before I get into the markets, let me just mention that tonight at 8 p.m. Sydney time, you can join me and Damien Klassen from Nucleus Wealth and What the World Funds as we discuss the latest in the markets. There's so much going on, so you can ask a question live and get the latest direct from Damien. Join me then. Anyway, European stocks slid to a one-month low and commodity prices dropped on Monday on renewed concerns about rising interest rates and China's spluttering economy, while Wall Street shares rose, reversing losses after Twitter agreed to be bought by billionaire Elon Musk. Fears over China's COVID-19 outbreaks spooked investors already worried that higher US interest rates could dent economic growth. US shares were lower throughout most of the session, extending last week's sharp declines. That said, though, the volatility index, known as Wall Street's fear gauge, did hit the lowest level since mid-March. Twitter shares rose on the news that Elon Musk, the world's richest person, clinched a deal to pay $44 billion cash for the social media platform populated by millions of users and global leaders. It's a seminal moment for the 16-year-old company that emerged as one of the world's most influential public squares and now faces a string of challenges. Musk has criticised Twitter's moderation, calling himself a free speech absolutist, and said that Twitter's algorithm for prioritising tweets should be public, and criticised giving too much power on the service to corporations that advertise. Political conservatives hope that a Musk regime would mean less moderation and the reinstatement of banned individuals, including former President Donald Trump. Musk himself also has described user-friendly tweaks to the service, such as an edit button and defeating spam bots that send overwhelming amounts of unwanted tweets. Discussions over the deal, which last week appeared uncertain, accelerated over the weekend after Musk wooed Twitter shareholders with financing details of his offer. Under pressure, Twitter started negotiating with Musk to buy the company at the proposed $54.20 per share price. Free speech is the bedrock of a functioning democracy, and Twitter is the digital town square where matters vital to the future of humanity are debated, Musk said in a statement. Twitter shares rose 5.7% on Monday to close at $51.70. The deal represents a near 40% premium to the closing price the day before Musk disclosed he had bought more than a 9% stake. Even so, the offer is below the $70 range where Twitter was trading last year. I think if the company were given enough time to transform, we would have made substantially more than what Musk is currently offering, said Jonathan Boyer, managing director at Boyer Value Group, which holds a stake in Twitter. However, he added, this transaction reinforces our belief that if the public markets do not properly value a company, an acquirer eventually will. Musk's move continues a tradition of billionaires buying control of influential media platforms. That included Rupert Murdoch's takeover of the New York Post in 1976 and the Wall Street Journal in 2007, and Jeff Bezos's 2013 acquisition of the Washington Post. Twitter said Musk secured $25.5 billion of debt and margin loan financing and is providing a $21 billion equity commitment. Musk, who's worth around $268 billion according to Forbes, has said he is not primarily concerned with the economics of Twitter. Having a public platform that is maximally trusted and broadly inclusive is extremely important to the future of civilization. I don't care about the economics at all, he said in a recent public talk. Musk is chief executive of electric car maker Tesla and aerospace company SpaceX, and it is not clear how much time he will devote to Twitter. This is great news for Twitter shareholders, as it doesn't seem like the company was going to get things right anytime soon. Tesla shareholders can't be happy that Musk will have to divert even more attention away from winning the EV race. Ed Moyer, an analyst at currency broker Onya, said. Still, Musk's 80 million-strong Twitter account is seen as an important free public relations tool for Tesla. The Twitter transaction was approved by the board and is now subject to a shareholder vote. No regulatory hurdles are expected, analysts said. Daniel Ives, an analyst at Wedbush, said the company's board of directors had its back against the wall once Musk detailed his financing package and no other bidders or white knights emerged. It was not immediately clear what the breakup fee would be or who would run the new company. Twitter's outsized importance as a mouthpiece for politicians, political dissidents and activists belies its relatively small size. Although it is only a tenth of the size of far larger social media platforms like Meta platforms, Facebook, it has been credited with helping spawn the Arab Spring uprising and accused of playing a role in the January the 6th storming of the US Capitol. After Twitter banned former President Donald Trump over concerns around incitements of violence following last year's Capitol attack by his supporters, Musk tweeted, "A lot of people are going to be super unhappy with West Coast high techs as the de facto arbiter of free speech." Trump, whose company is building a rival to Twitter called Truth Social, said he will not return to Twitter, according to a Fox News interview. And the White House declined on Monday to comment on Musk's deal, but said that President Joe Biden has long been concerned about the power of social media platforms. "Our concerns are not new," said White House spokesman Jen Psaki, adding that the platforms needed to be held accountable. The president has long talked about his concerns about the power of social media platforms, including Twitter and others, to spread misinformation. After the deal, Wall Street reversed course with a late rally by growth stocks, and the Nasdaq ended sharply higher. The Dow cut losses to close higher as well, as dip buying in tech stocks ahead of a crucial week of quarterly results of big tech steadied the broader market just as global growth worries returned. So the Dow Jones Industrial Average gained 0.64%. After falling 488 points intraday, the S&P 500 was up 0.64% and the Nasdaq climbed 1.3%. Big tech sparked a broader market turnaround, led by gains in Google, parent Alphabet, and Microsoft, ahead of their quarterly results expected tomorrow. Amazon, Meta, and Apple also cut losses to end above the flat line. Now, those 5 mega-cap stocks, which account for more than a quarter of the weight of the S&P 500 index, need to deliver quarterly results that drown out the fears of a global slowdown. In a nutshell, the street needs to see the fundamental drivers in play on the cloud, enterprise and consumer front to show the feared slowdown is more bark than bite at this point of the cycle, Wedbush said recently. Global growth concerns resurfaced on fears that the rising COVID-19 cases in China could spark another lockdown in the world's second largest economy, and energy stocks bore the brunt of the pressure, down more than 3% on fears that the lockdown in China could sap demand. It looks as though demand for gasoline, diesel and aviation fuels in China could drop by around 20% year over year in April. Despite the rebound, some on Wall Street said there is still more likely downside ahead as selling conditions haven't yet reached extreme levels. We don't see the daily, weekly or monthly charts as necessarily oversold at this point, which implies there is likely more downside ahead before current selling conditions hit extremes, Jenny Montgomery Scott said in the note. You can tell growth wanted to rally all day, but the market was holding it down. The Twitter news came, and that was just a green light to start buying some of the growth names. They have been oversold for a while, said Dennis Dick, a trader at Bright Trading LLC. And earlier, Europe's stock 600 index dropped 1.8% to close at its lowest since mid-March. Commodity stocks slumped 6% as global worries overshadowed relief from French presidential results on Sunday, which saw Emmanuel Macron edge past far-right challenger Marine Le Pen. MSCI's benchmark for global equity markets fell 0.41% to 668.85, and emerging market stocks fell 2.61%. Before that, Asian markets had had their worst daily decline in over a month on fears Beijing would come back into COVID-19 lockdowns. The stocks rebound from the first quarter correction and hit a wall of rising long-term interest rates, Morgan Stanley Chief Investment Officer Lisa Shale said in the note. With the Fed talking about a faster and larger balance sheet reduction than anticipated, real yields are approaching zero from their deeply negative territory. With the nominal 10-year US Treasury correcting 2.9%, the equity risk premium has plummeted. The euro slid 0.9% near the session's trough, and its weakest level since the initial COVID panic of March 2020. The reality is there is more to the French election story than Macron's win yesterday, said Rabobank's FX strategist Jane Foley. France will hold parliamentary elections in June, and Macron also seems likely to maintain pressure for a Euro-wide ban on Russian oil and gas imports, which could cause near-term economic pain. We had German officials saying last week that if there was an immediate embargo of Russian energy, then it would cause a recession in Germany, and that would drag the rest of Europe down and have knock-on effects for the rest of the world, Foley said. State television in China had reported that residents were ordered not to leave Beijing's Chaoyang district after a few dozen COVID cases were detected over the weekend. China's yuan skidded to a one-year low, while China stocks saw their biggest slump since the pandemic-led panic selling of February 2020. The dollar index rose 0.65% and climbed to a two-year high, and it touched a peak of 1.0695 against the euro. Investors wonder how fast and how far Federal Reserve will raise US rates this year, and whether that and other global strains will tip the world economy into recession. In Europe, 134 of the Stock 600 will put out results, including banks HSBC, UBS and Santander on Tuesday, Credit Suisse on Wednesday, Barclays on Thursday and NatWest and Spain's BVA on Friday. I wonder whether just meeting expectations will be enough. It just feels like maybe we'll need a bit more, said Rob Carnell, ING's chief economist in Asia, referring to jitters about big tech following a dire report from Netflix last week. Hong Kong's Hang Seng fell 3.7% and the Shanghai Composite Index slid over 5%. China's central bank has fixed the midpoint of the yuan's trading band at its lowest level in 8 months, seen as an official nod for the currency's slide, and the yuan was sold further to a one-year low of 6.5092 per dollar. The higher dollar pushed spot gold 1.7% lower, and US gold futures settled nearly 2% lower at around 1,896, and palladium prices were down nearly 10% on worries over Chinese demand. In oil, Brent crude closed 4% lower at $102.32 a barrel, and US crude settled down 3.5% to $98.54, its first close below $100 since April 11th. And Eurozone bond yields also fell. Money markets are pricing in a 1 percentage point increase in the US now at the Fed's next two meetings, and at least 2.5 points for the year, which will be one of the biggest annual increases ever. And the week will also see the release of US growth data, European inflationary figures, and a Bank of Japan policy meeting, which will be watched for any hint of response to a sharp fall in the yen, which has lost 10% in about the last 2 months. So, whilst there was a bit of an upswing late in the day in the US, probably thanks to Twitter, the broad fundamentals still remain in uncertain territory, and the downside risks are very significant at the moment. So expect more downside before any recovery, and the downside could be quite significant if indeed we get very strong interest rate rises, particularly from the Fed. Time to hunker down and watch what happens. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.